What's going on, guys? It's your boy JT knows things, and this is the glorious Crypto Den. And today, I wanted to cover a topic that clearly, um, y'all did not like. I made a video recently talking about day trading and how I think it's fucking stupid. And I wanted to show you some really cool data that supports this theory, if you will. Before I get into it, for those who do not know, I am Jake Tullis. I also go by JT. I run and operate a digital asset hedge fund out of Cincinnati, Ohio, called Bleeding Edge Capital. Now, at Bleeding Edge Capital, I basically do a lot of really boring research, so you don't have to, and so my investors don't have to. I'm in the depths of white papers, exclusive newsletters, things like that, and I basically spend most of my time either doing software development consulting or research for my fund. And today I want to show you very cool resources that we use to make our decisions, and also just to show you guys that some of the best in the world, the elites of elites, people that manage anywhere from 5 million in a hedge fund to 500 billion, if not more, trillions. These are the strategies they deploy. The document I'm going to show you, actually, there's two of them, come from Price Waterhouse Coopers. For those who do not know, that is one of the big four. They are one of the most credible sources, and the data is sourced through PwC in partnership with AIMA, which is an organization I'm a part of. It's called Alternate Investment Management Association. So people like me that manage hedge funds, private offerings, or alternative investments, someone like that is a part of this, global group of other hedge fund managers. And again, this space is anywhere from the smallest fund is less than a million, and it could be up to the 10 trillions like BlackRock. We're all a part of the same organization. So with that, let's go over here and take a look at why exactly is day trading or short-term mindset in this game or any game a bad idea. I have actual data to show you for all those that raged on my last video. Okay. Now, as I said, this is done by PwC and AIMA. Okay. Those are the two big ones that I wanted to call out. Basically, what this is, it is a hedge fund report. This is 2022. This is 2023. This is an aggregation of every hedge fund in AIMA that responded to their survey, which there were hundreds, if not thousands, that responded. They cite all that at the bottom. But this general report is something PwC releases every year to give us large kind of aggregations or just large sets of data for us to look at. Okay. Now, some of this stuff, not that important. I'm just going to go right to the meat of it first. I thought actually, this is kind of interesting. Shows you kind of the launching of the funds. I'm sure these guys all did very well, but what I wanted to call out is all of these strategies here. Okay, discretionarily long or short, quantitative long or short, discretionarily long only, quantitative long only new, and then market neutral and multi-strat. So in general, discretionary versus quantitative. Discretionary means it's 100% up to the fund manager and their decision making process. They have full autonomy over the fund, and they, at their discretion, select different assets to purchase. Where quantitative has a very strict rule set and model that they trade with that has proven success. So, quantitative, rule based, discretionary, more research based is how you could think of it. Okay. Where like these guys just, they plug in all their numbers into the model and they make a decision basically. They're very data driven, where research is more, or I'm sorry, discretionary is more research and like fundamentals, if you could think of it that way. Market neutral is essentially a strategy where they just try to profit regardless of the direction, as they say. So it could be, you know, selling shorts, longs, any insurance on trades. They have a lot of different ways, but they really are, they're boring in my opinion. And then multi-strat is basically what I am, although I lean discretionarily long. I'd say over 80, 90% of my positions are that way. Technically, I would be a multi-strat because there are some that I have more midterm, you know, perspectives on. Okay. These are the most common, as you can see. And then this is really where I wanted to show you. We'll go back to some of this cool data here. This is actually, yeah, we'll definitely touch that. But this is the crux of what I'm talking about, guys. I want you to look at the strategies here. Just take a minute and really, really look. Do you see how well long does? Now, mind you, these are the smartest, the most elite. They are playing at the highest of highest levels, right? And you can see right here which strategy outpaces the rest, right? Just take a look, guys. Discretionarily long does the best. Discretionarily long does the best. Long and short, long and short, quantitative. Again, these are the rules, the rule followers, people that use models. Quantitative short would be a day trader, okay? Um, Guys like me run circles around day traders, okay? Because the reality is, when you're swapping in and out of an asset 50 times a day, the amount of profit you're going to milk from it, the final balance of your portfolio, at the end of the year, will not even be as high. If we started with the same amount of money, what this data suggests is that I personally, not going in and out of any asset, just holding it for the same period of time, am going to either double, if not quadruple, your returns. And my strategy is a lot easier to implement. The process is in underwriting the assets, knowing what to hold and for how long to hold it, versus going in and out of an asset and using models and data to just basically sweat all day a return, trying to milk 2% a day, 1% a day, 3% a day, 5% a day, whatever it is. It works. There are funds that do this, okay? But it's not as good as discretionarily long, which is why I think it is fucking stupid, okay? Absolute stupid. Before I close out, because I promised I would make these brief, I thought this was like some cool stuff. So if you look at the starting AUM and look at how much it grew in 2 years, yeah, in 2 years. Let's just make sure. Yes. Hold on. Here we go. They started tracking this back in, okay, 3 years. Okay, so 3 years ago. So in 3 years, they're able to, on average, turn 3.5 into 58. That's incredible. That's only in crypto, real estate, or some crazy, crazy deals. Um, I thought that was really, really neat. And then you can see the percentage of funds that hold a bunch of different money and how much. You can see that, like, not a lot of funds. You think hedge fund manager, you think, God, they're wealthy, fuck them, whatever. Reality is, there's a lot of small managers that, are in the process of growing their books. The more than a billion is probably the top 5%. So it takes a long time to build the business out. This was taken in the bear market of 2023. I thought that it would be cool to show you one thing on here. And if you want these, reach out. I'll happily send them to you. Um, Here we go. You can see here, and this is something I admit. If you're discretionarily long only, you definitely lose almost the most. Fund to funds is the worst, but you lose almost the most in a bear market. If you don't cycle out of the market and capture profit, you are going to really get hit for a period of time. even with the performance, actually, this might be cool for you guys to see as well. Sorry, I'm kind of getting sidetracked here. All coins traded by Crypto Hedge Fund. You can see the percentage. This is pretty cool. Now, some of this actually has a lot. It actually has a lot to do with the custodian the fund uses because we are limited into what assets we can play with, based on what company is going to custody the tokens because they won't let someone like me with clouds in their ceiling to actually hold the crypto. And it's a good thing. It's a very good thing. But you are limited. Your strategy is limited, so it's going to be a little bit more focused than what you would imagine. Um, and then this was the last thing here. So there should be. Here we go. Yeah, in the bear market, you have what is that? Is that 3% thinking the bear market? It's like the end of crypto times. 50%, half the people at this level, not even impacted. You guys, what that should tell you is the most prestigious place to be investing in crypto, the best of the best again. They are crushing it discretionarily long. And when when their like portfolio gets cut in half, they're not even phased. The reason for that is because they know something that you don't, or that most people don't. Okay? That this technology is here to stay. And it makes no sense to sell a good asset unless you're done buying that asset for a period of time. Otherwise, you should be accumulating. Never financial advice. I'm bringing you this research so you can make your own decision, but I wanted to back my stance up with some evidence and data for you guys. Go long term and relax. Dollar cost average, like that is definitely the best way to invest in general. It doesn't matter if it's crypto or anything else. It's as long as you're doing it with the right stuff, okay? And that's really important. That's why you subscribe to this channel. I talk about the stuff that is worth exploring. I never say invest in anything, but I will show you my research and I will show you or explain my opinion on things. I can't explicitly say what I'm buying and how much I'm buying and when I'm buying, but what I can do is help you make better decisions. And that is my mission in this channel and all the content we put out. I hope this was helpful to all the haters out there. Open your mind a little bit to some other ideas, okay? Because I'm telling you, day trading just doesn't beat discretionarily long. All right, guys. Peace and love. Take care of one another. Until next time, I'll see you.